I'm Chris Massey, and welcome to this week's Video Insight. Yesterday, I was reading the announcement that Amazon's about to open its first physical grocery store, and I wondered, what kind of company is Amazon exactly? And even more importantly, how do investors view Amazon when considering risk exposures? My query was initially prompted by the fact that I was reading the Amazon article in the technology subsection of the company section of the Financial Times, a leading UK news publication. And while many people might associate Amazon with technology, this article was reporting on grocery retailing and offline or bricks and mortar shopping at that. Sure, there's an app and artificial intelligence behind the checkout-less store format, but it's still a store. Yet the article I was reading had not been placed in the retail and consumer subsection of the paper. At this point, I was interested in how the experts classified Amazon, so I turned to the Global Industry Classification Standard, or GICS. GICS was developed by MSCI and S&P in the late 1990s for the financial community to consistently classify companies by sector. There's 11 key sector groupings and many subsectors below them. Interestingly, Amazon's GICS sector group is consumer discretionary. I could see immediately how this may create confusion, and I think it may be helpful for listeners and clients for me to mention how we think about Amazon's industry exposure. Given that Amazon has a long position in both the Montgomery Global and Montaka funds, we are of course aware that the company falls under the consumer discretionary GICS label. But we look deeper than this to identify the business drivers and the risk factors we've assumed by investing in Amazon. In our minds, Amazon is both a retailer and a technology company. On the retail side, we appreciate that Amazon is leading the charge in online shopping through its website platform, Amazon.com. In the medium term, Amazon's $125 billion of retail revenues will be certainly driven by the paradigm shift to shopping online rather than the overall growth of retail spending in the economy. And at the same time, we understand that Amazon's longer term market and profitability potential is likely to be best framed by the size and shape of the retail spending pie. This is a retail business that has been enabled by technology. On the technology side, we focus on Amazon Web Services, or AWS. This is Amazon's highly profitable cloud computing business, which generates $12 billion in revenues, but is half of Amazon's profits. AWS sells computer processing and storage capacity to customers. Corporate IT departments are spending more and more outsourcing these services every year. Like the retail shift from offline to online, AWS's rapid growth is being driven by a paradigm shift in the consumption of IT services. This is a tech business benefiting from scale and a new consumption model. In our minds, the only way to truly manage the risk and determine the upside potential of a business like Amazon is to understand the markets in which it participates in and the methods that enable its participation. We're then able to have a rich discussion and to disaggregate the key risk factors. We believe this approach will continue to benefit our clients. Thanks for joining me today, and remember to follow us on Facebook and also on Twitter.